Hello everyone, and welcome to the third video series of the KKR Credit Income Fund, or KKC. I am Chris Sheldon, a partner with KKR, and I oversee our global leverage credit business. Today I plan on covering the following. First, an update on the performance of KKC. Second, our change or our optimization of the structure of KKC, which we think is beneficial to all unit holders. Third, an overview of the credit markets. And finally, a portfolio snapshot of the fund. If we start with KKC's performance, this slide should be familiar to most of you. It tracks the historic performance of the fund, both from an NTA perspective, or a net tangible asset, overlaid with the unit's share price. It is our goal and aim to narrow the gap between the share price and the fund's NTA. Now, we can't necessarily control 100% of that. We do believe that with strong underlying asset performance, consistent distributions, and improved transparency, both from reporting and frequent investor dialogue, that gap should help narrow. Now, the gap has tightened since we last communicated to many of you last November, but there is more work to be done. As such, we are focused on optimizing the structure, which we think will help. So what is the structure optimization? Essentially, we are improving the financial plumbing in order to lower cost and increase flexibility. Right now, KKC owns two fund positions, one in Global Credit Opportunities Fund, or GCOF, and another in the European Direct Lending Fund, or EDL. Those funds currently make quarterly distributions, which ultimately passes along those payments to KKC unit holders. What are we changing? We are converting KKC's GCOF holdings into a separately managed account via an distribution in kind. This will be in two stages, 80% this month and 20% in April. This separately managed account will be managed in the exact same way as the commingled fund. Same investment team, same portfolio manager, same strategy. This will solve for lower costs, increased flexibility in regards to redeeming capital and distributions in addition to investments. KKC's investment in EDL will remain as is. Upon completion of the formal and final optimization in April, we'll make a final announcement to the exchange. We think this is in the best interest of all unit holders, and we're excited about the optimization. Now let's move to the meat of the discussion. The credit markets. We've had no shortage of headlines in the US or globally in 2020, and it is continued into 2021. As a result, it's been an eventful last 12 months for all of us. Continued increases in COVID cases globally, which has created multiple different governments and regions to handle it in their own way, some better than others, but leaving a long trail of dust for us all to clean up for the years to come. Now, in the US, the Fed stepped in quickly. This, coupled with election and uncertainty, has led to a steepening of the credit curve and the treasury curve, and a market that is very focused on stimulus and the next stimulus. This has driven spreads tighter and the equity markets higher. A closer look at the credit spreads show we are back to pre-COVID levels. But these spread levels are a bit misleading as the market has evolved and become very much higher quality. This is the result of the distressed and the defaulted assets leaving the indices, in addition to all the investment grade rated investments that have been downgraded and are now part of the high yield market. Essentially the triple Bs being downgraded to the double Bs. This has created a much higher quality high yield market. And when you compare these spreads of this higher quality market, credit still looks really attractive relative to other spread assets. And one of the consistent themes that we hear from all of our partners out there, whether it be large institutions, public pension plans, insurance companies, or the individual investor, is their thirst and their demand for yield and income. As such, we feel really good about the near to medium term trends in the credit markets as we have tailwinds behind us. But what 2020 has done has created real dispersion in the market. By sector, there is a 19% delta in returns. But that is not the shocking part. When looking at the subsector level, that 19% grows to 98%. What that means is real dispersion of the haves and the have-nots, or the perceived have and have-nots. And credit selection is ever so important. In this low rate environment, making up for a mistake is extremely hard, particularly when the majority of the high yield market is yielding under 4%. And being nimble and flexible is going to be important too, as the market is that much more volatile than it was a decade ago. And we should get used to this volatility, but we don't have to fear the volatility. If you have flexibility, if you're able to be nimble, you can take advantage of it. And that is what we're trying to do at KKC, particularly in this new structure. Now, looking specifically at GCOF, we have done that, and we have demonstrated the ability to materially outperform in periods of volatility without taking on volatility within the fund itself. This slide illustrates our up capture and our down capture. What does that mean? It means when the market is up 1%, we've historically been up 1.12%. And more importantly, when the market is down 1%, we've only been down 0.78%, or 78 basis points, focusing on principal protection and preserving everyone's capital. 2020 also illustrated that this volatility can dissipate extremely quickly, and having the flexibility to pivot real time is a differentiator. You can see the evolution of the market in 2020 by looking at the yield buckets of the market at different periods of time. The markets moved lightning fast. Now, passive funds materially underperformed in 2020. Over 2/3 of the high yield mutual funds underperformed the high yield index. And constructing a portfolio that is based on bottoms up credit selection versus trying to mirror an index and then providing a macro overlay to that has worked for us. And the next couple slides illustrate some of this differentiated portfolio. As you can see from the portfolio, it is extremely diversified across asset classes, sectors, and ratings. In addition, it is over 90% senior, which means top of the capital structure. And one important to note is within the ratings, that non-rated bucket primarily represents the European direct lending assets. Now, many ask, is the credit opportunity over? The simple answer is no. The market has created dispersion and a great haves and haves not market. And we are still seeing attractive risk reward and many investments offering outsized returns. And many of these sit in what we call no man's land. These no man's land credits or companies are often avoided by the market buyers or the index buyers by the perceived risk. And they're often missed by the absolute return buyers because they don't meet the yield or targeted returns that they are promising their investors. Now, no man's land has a negative connotation to it, but we are very comfortable living in no man's land. We feel like we have a differentiated platform to understand these businesses, find the have-nots that are haves or should be haves, and avoid the have-nots that should be a lot wider or lower in dollar price. And we've been very successful playing and finding these investments in no man's land. In summary, I would like to first and foremost thank you for all your support. We are focused on doing all we can to narrow that gap or discount to NTA. We think the structure optimization will help. We think we are set up well to take advantage of this current dispersion, to be nimble and flexible, and take advantage of all the volatility the market is likely to give us over the coming years. Thank you, be safe, and talk soon.